You're watching Business Unusual, and we're going into Mama Made It Friday in just a little bit. But first, I want us to take a look at today's top business stories. And a lot of that has to do with that announcement that came through from the South African Reserve Bank yesterday. Consumers getting a sigh of relief with the repo rate cut by 25 basis points, or 0.25%. But is this where it ends? And of concern for the South African Reserve Bank is the slashing of the country's growth forecast from a mere 1 percentage point to 0.6%. We also heard the governor of the central bank, Isaah Mhlanga, speaking about some of the upside risks, of course, for the inflationary environment. And to discuss this and more, I'm joined in studio by Isaah Mhlanga. He's the chief economist at Alexander Forbes Investments. Makwabo, minjani?
All right. How are you doing?
I'm very well, thank you. Isaah, many of us, I guess, had anticipated that 25% or 0.25% cut in the prime lending rate. And I guess it could have been worse. I mean, many people have suggested that the MPC is rather dovish on some of these issues, and we could have seen rates unchanged as well. But as consumers and businesses alike, we'll certainly take this one.
Yeah, absolutely. I mean, 25 basis point for the consumer is a sigh of relief, but for the economy, it's not going to add much. Obviously, if you read the MPC statement, it's what you could call a hawkish cut, because at the end of the statement, the governor emphasized that he would want to see inflation expectations trend lower towards 4.5%, and they currently sit around 5%, which means the likelihood of further cuts is very small. But also, if you consider the global environment, some factors that led the Reserve Bank to cut is, of course, the central bank monetary policy regimes, which has moved towards interest rate cuts, with the Fed expected to cut at the end of this month. But the trade tariffs is still a live risks that can come back again into the market, which may lead to a risk of trade resulting in a weaker currency. And you know the weaker currency has a significant influence in terms of how monetary policy is set. So we still have a number of risks, including, of course, given that growth is now forecasted at half of what it was at the beginning of the year, fiscal pressures from Eskom, and also tax revenues are likely to be much slower than what was forecasted. So the risk of a Moody's downgrade is there in the market, which means that is something the SARB is concerned about.
You touched on the trade tariffs and, of course, the trade war between Beijing and Washington there. And I must say, Donald Trump has been nothing short of erratic when it comes to making decisions about the trade and industrial policy of his country, and sometimes those decisions made on his timeline.
No, absolutely. You could say the U.S. is one of the new emerging economies in terms of how they make policy. It's very abrupt, unpredictable, which is uncharacteristic of a developed country like the U.S., which means the risks that come from there are quite significant. Remember, everybody, that trades mostly you conduct your trade through U.S. dollars. So if there is an announcement on tariffs, it may lead to a risk of trade, which strengthens the dollar, and by conversely, it's going to weaken emerging market currencies, including the rand, and that is going to feed through our inflation profile through fuel price increasing, which will be a direct hit to the consumer, and also increasing inflation risk on the upside.
And I guess let's maybe align on expectations here when it comes to many of the consumers who are viewing this particular show. When we say relief, we're not talking about sizable amounts here. If you have, I guess, a car loan of about 200,000 Rand, you potentially are going to save about 25 Rand a month on that installment. And if, of course, you have a much longer term commitments and obligations, like a bond for that instance, you might end up finding yourself saving a bit more, but nothing in the tune of anything that I guess would make you worry less about that installment.
No, absolutely. It's 25 basis points. It's a 0.25%. It's not that significant to really relieve consumers, but anything that you can be given how difficult the economic environment is, you will take it. But I guess for consumers, the bigger problem is the rate of job losses and also lower growth in incomes. That is where the bigger impact on consumer is coming from. Yes, you can get a small relief in terms of interest rate cuts, but you're still quite constrained in terms of security of jobs and your income, and that is what consumers will remain concerned about. This is quite important because the cut in interest rate, the expectations in some will be that savings that consumers have are likely to spend, which is unlikely. They're likely to use it to pay off debt or to increase the debt repayments, which is not necessarily something that improves economic growth.
Now, Isaah, we know every time the MPC makes this kind of statement, or Governor Isaah Mhlanga goes and makes a statement of the MPC, there's always some clues that are given there about what we ought to expect in the subsequent meetings. One of those clues is around inflationary expectations. So the committee doesn't make decisions on where inflation is now, but where they expect inflation to be into the foreseeable future. We heard the governor yesterday talking about some of the things coming out of their quarterly projection model, expecting headline inflation to average around 4.4% in 2019, seeing that rise between 2020 and 21 all the way to 5.1 next year, 5.1%, and then coming back, I guess, to around the midpoint, 4.6% in 2021. What are the things that potentially could make this model shift out of kilter and potentially change some of the clues that the governor gave us yesterday?
Obviously, the one factor is the currency. If it weakens, that will push that inflation profile. But also, if we get downgraded by Moody's, perhaps over the next 12 months, that will increase also the portfolio outflows that will lead to a weaker currency again. But another risk that we have is the potential for oil prices to increase because of the geopolitical risk between the US and Iran. And also OPEC just cutting production to sustain those prices. We know as of yesterday, the International Energy Agency downgraded the forecast for oil prices because of lower economic growth globally. That is positive from an inflation point of view.
And when we look at other things, I'm quite interested, for instance, in administered pricing and some of the comments that the governor made on the impact that electricity and, of course, the challenges that we see at Eskom, which didn't get what they had asked for from the energy regulator by way of a tariff. But it doesn't mean that we're not going to see tariffs rise on electricity in the foreseeable future, especially in light of that unbundling, which is set to come underway in the next few months.
If you look at the history of administered prices, they've tended to increase consistently over time. And remember, administered prices in simple terms, these are just taxes, which the state collects through electricity hikes, through levies on water, through fuel levies. These are taxes that go directly to the state. And given how constrained the fiscus is, you would have to expect an increase in these administered prices in the coming years, because there is no other way. With economic growth quite weak, the state has to find some ways to raise revenues, or they have to cut expenditure, which looks quite difficult politically.
And if you look at the crisis at municipal level, and even what Minister Lindiwe Sisulu, I should rather say, was saying about the state of play in the Department of Water and Sanitation, we're likely to be paying a lot more even for the reticulation of water into our homes, which I guess will add to that burden of administered prices.
No, absolutely, which just adds to the burden that the consumer is feeling. And remember, the consumer is 60% of the economy. And if you see all these burdens or all these costs just increasing for the consumer, the prospects of an increase in economic growth just dwindles, which then shifts the conversation to say the private sector should be encouraged to invest so that it can be a kickstarting mechanism for economic growth. Sure. Remember, this time around, it looks quite different. If you look in 1998, when the economy slowed down, it picked up on the basis of a faster economic growth globally. In 2001, again, after the dot-com bubble, global economic growth picked up, South Africa's economic growth, the financial crisis as well in 2008, 2009, the global growth plus fiscal policy kickstarted South Africa's economic growth. This time is different because we don't have strong global growth. Yes, it's still positive. We don't have the fiscal space, but monetary policy also is quite constrained because, remember, we compete with other emerging markets in terms of capital flows, which means our interest rate in real terms needs to be competitive so that we can attract portfolio flows to fund our current account deficit. So the Reserve Bank cannot cut as much as they would want because they still need to set policy in such a way that we continue to attract capital flows that fund our current account deficit.
So definitely shouldn't be popping the champagne anytime soon for this 25 basis points.
No, not necessarily. And even when you read the MPC statement, they say they're going to be data dependent, which means it's neither a cut that comes nor a hold. We just don't know. It's going to depend on economic data that comes out, which will inform the monetary policy on what next move will be.
Okay. Cancellation.
All right.
Thank you so much. That there was Isaah Mhlanga from Alexander Forbes Investments, where he is the economist there. And after the break, we go into Mama Made It Friday.